We are at the lowest level of existing home sales since 1995. But we also have 70 million more people, almost 80 million more people in the US than 1995.
Hey, property management friends. What a time to be in real estate, huh? Inventory is rising. Are we about to experience a drop in home values? And how might those tariffs affect housing demand and prices? Will renters ever get back into the purchase market? And when will investors finally open up their pocketbooks and start buying new properties again? Well, if you're like me, you've got both questions and opinions about the housing market. So I wanted to call the person that I go to for the most up-to-date market data on housing, Lambert. In case you aren't on LinkedIn or you're living under a rock, Lance has created an amazing data outlet for all things housing in the US called ResiClub Analytics. I've been following him for a while. I've been subscribing to his newsletter, and Jen and I actually even went up to his conference in New York City last December. And I trust Lance so much that I want to start introducing him more to my property management friends. So I'm going to ask him all of the questions that you have on your mind and that I had on my mind in this episode. And I'm also flying him down to Fort Lauderdale when we have the Strategic PM Summit, which is August 21st and 22nd. It's the premier event for property management entrepreneurs and executives. And if you like what you hear on this call, just know that you're going to have small room access to Lance if you come to the summit. So if you go to strategicpm.com, you'll find out all the information you need there. Now, as you watch this episode, please comment on what you agree with or disagree with that Lance and I are saying. And even consider sharing this and tagging your colleagues. I really want to turn our access to Lance into a conversation. And I can assure you that he will be reading the comments and will probably comment back. Okay, without further ado or additional news, let's jump in to the main segment. All right, Lance, thanks for joining us today. Right off the bat, I just want you to tell us a little bit about ResiClub and why you started it.
Yeah, so a long-time financial and data journalist. I've worked at places like Bloomberg, worked at Realtor.com for a couple of years covering housing, and my last stop, I was the real estate editor over at Fortune magazine. And during that time, I kind of got bit by the entrepreneur bug, and my coverage area has always been housing, at least for like the last 6-7 years. And that really goes back to my time at Realtor.com, where I had thought I was going to leave financial media, thought I was going to become a data scientist, kind of took that job as a bridge job, and got to work with a lot of their data as I was doing a lot of these like data science courses on the side. And during that time, I just got to understand the ins and outs of housing data, down to the property level, a lot of, how to read active inventory, how not to read some of the housing data that gets misinterpreted all the time. And so when I decided I was going to stay in financial media and I left Realtor.com to go to Fortune, that was around the end of 2019. And so while I was there, I was doing a data newsletter for Fortune 1000 executives, like the CEO of Target was a frequent reader. And when I was there, the pandemic occurs and housing starts to be very strange, right? People are like, what is going on here? The data starts to show that the market's starting to shift into overheating, which is kind of wild because we were in a period of a big spike in unemployment, lockdowns, all of that. And so there was a real hunger for better coverage of housing. So I started spending more of my time writing about housing just because I was interested in it. People were hungry for it. And over those next few years, as we go through the pandemic housing boom, the subsequent mortgage rate shock, I just built up a big readership for it. And like I had said earlier, I had already gotten bit by the entrepreneur bug. And so by the end of 2023, I decided to leave Fortune to start ResiClub, go on my own. And so ResiClub is a news and research outlet that focuses on the U.S. housing market. So we're trying to look at what is going on across the country, county, metro, zip code, to figure out the different variations, whether it's regional, if it's by different product type, resale, existing, and to explain that to a group that's across the housing sector. Our audience isn't just, home builders, isn't just the loan officers, isn't just real estate agents, isn't just single family landlords, property managers. It's everyone. It's across the whole housing sector, including into, build to rent, SFR, institutional crowd, capital markets, banks, insurance companies read us as well. And so just trying to really have great coverage of not just what's happening in the buying and selling dynamics across the country, but also explaining different trends and connecting the dots, whether it's the home building side, existing home sales, mortgage, refi, just kind of connecting all the dots, and then also covering insurance as well. And so that's what I've been doing. Started back in October 2023, and it's just been a race, and I'm loving every bit of it and trying to just continue to make my coverage better and stronger every day.
Yeah, I found you early on. I think I told you I have no clue, but I'm assuming somebody shared something and I was intrigued. And I was intrigued enough that I actually signed up for a newsletter, which I rarely do. Lance, to be honest with you, you're one of the very few newsletters that I still receive. Yeah, and the things that I really enjoyed is how graphical you're making this giant data set. So you boil it down into graphics, which is obviously very easy for somebody like me to absorb. But then you also give analysis, but the analysis is very high level. And like you said, you have this large audience, and I'm kind of reverse engineering why it's so widely applicable. It's because somebody like me who's looking at it from a rental trend market, I'm able to extrapolate what I need because the analysis is just it's valuable, but it's just basically here's what we're seeing, here are the facts. You kind of make your own decision. Is there kind of a philosophy you have about that, or is that just something that's happening naturally? How would you kind of describe the way that you present the data?
Yeah, so I start at it from a point of view that I think that people are very busy. They have like TikTok brains now, ADHD brains, right? Everybody's on media everywhere, getting pulled into very different directions, and they're very busy people. And especially the people that are interested in housing insights, they're running businesses. There's a lot of entrepreneurs in this space. They don't have a lot of time. And so my philosophy is I need to boil things down to be very digestible, right? One thing that I spend a lot of time on that might sound silly to a lot of other, people who work in media is my headlines. My headlines for charts in particular, because I want the person who's going to consume that chart to be able to read that headline and quickly just take in that insight, right? And so everything that I do, I try to make it very digestible. There are things that are kind of like high level, right, that might not always make sense to people, but I'm constantly trying to refine those to be digestible. And then I also try to create a little bit of like self-learning as well. So if people want to like figure out more of like what's going on in this market, I try to make as many of my charts and maps interactive as possible. So if people want to like spend time and navigate through their market, I try to make it very simple to where they could open up my interactive and kind of go through some self-exploration of their market.
Excellent. And we're going to share for the listeners, we're going to share some of those headlines he has and get Lance's insight on the current market. And we're also going to talk about how you can use some of that in your own business. But I do want to just get a sense, because when you talk about it, it's so simple. You say, I make my charts interactive. But I know this is a lot of data and it's taking a lot of work to make it simple. So I wanted to ask about that just at a high level. You probably take it for granted, but how much data is your team looking at every week, and what are these data sources? Just kind of give us a high level view so that people understand where this market data is coming from.
Yeah, so a lot of the data that we access can be accessed publicly. Some of it from Zillow, some of it from Realtor.com, some of it from the census. You have a number of different sources that we pull in from Bureau of Labor Statistics. We have some regional different data sources that we pull in. But what we're doing is we're constantly getting more and more data and then finding out better ways to analyze that data. And then we create metrics for that data. So maybe it's, adjusting for population size for different markets, right? Maybe it's creating different indices to kind of help to better understand market dynamics in those places. But so we have a lot of data. Some of this is just taken me years and years to learn and understand the data, and we're constantly moving to more data sources. And I don't know how much you want to get into the weeds, but the way that I do it, and I hired a data editor, a data journalist at Fortune magazine who used to work for me to come work at ResiClub. And what we do is we kind of like divvy up data sources. And my view is that every time you take on a new data source, somebody on my team needs to be an expert in that data. And so we split it up. And, if I need questions on X, Y, and Z data, I go to her and I'm like, hey, we have to be on our toes, and we have to know that we're going to get a lot of questions. So we have to understand the ins and outs of the data. So it's a slow process, and I'm slowly taking on more and more data. But in terms of the charts, one thing that I do is I have around 1,600 different charts, and a good number of them I will update quarterly, monthly, yearly, semi-annually with new data. And so all I do then is I put in the new data, and the chart's already ready to go. And so it's slowly a compounding effect where we're constantly trying to take on more data, analyze it, understand it, and be able to explain that very quickly to people. So there is a lot of work that goes in on the back end on that side.
Yeah, I'm guessing it does when I look at these. So that's why I wanted you to be able to talk about that a little bit, because the finished product is unbelievably digestible and easy to look at. So that's great. So you saw that I posted on LinkedIn, and I asked some of our contacts what they wanted to ask. One person had a question about data, which I think is really, useful to the listeners of this show. Do you track real estate investor activities separately from like owner occupied home sales, or is it just overall the data is the property changed hands and that's really all you're reporting on?
Yeah. So I do a lot of investor analysis as well. There is some public data that anybody can look at, like the Redfin. If you go to Redfin, you could download some of their data and look at it by like Metro. I also team up with Parcel Labs, and they have really great individual parcel data, individual property data. And that's how I figure out, how many homes do these different institutions own? And the way that Parcel does it is they know all of these different LLCs and companies that the parent company buys through and holds, right? And so they aggregate them up. And so that's a nice way to figure out what are their portfolios, and then also do a portfolio analysis to be like, okay, where are the markets they're expanding in? Where are the markets they're net selling in? What are the different types of homes that they're buying? Are they 2, 3 bedroom? Where are they getting them? What's the typical price point in these different markets? And so then I can kind of start to understand the different trends for capital deployment on the institutional space. And so one thing we're actually seeing right now is we've seen a little bit of an increase in the number of institutions that are a little curious about buying at the very bottoms of the market, like the Section 8 types, right? Mm-hmm. And so Section 8 is around, usually when people hear Section 8, they think multi, but 28% of all Section 8 is single family, right?
Yeah.
And at the very bottom of the market, you haven't seen as many of the institutions playing, whether it's AMH, Invitation Homes, they've kind of stayed a bit above that. You do have Vinebrook that has kind of bought at that level, but the largest institutional homeowner in America, Progress, their parent company, the private equity firm that owns them, they announced last month that they are starting an institutional fund to buy Section 8. They want to get 2,000 homes there. So that's kind of that's what I try to do in that data, is try to figure out what are the different trends and, where are these different institutions deploying capital. Now, of course, the institutional level, while it gets a lot of the headlines, it's actually the smaller player in the market, right? The biggest player are these mom and pops who own under 10 homes, right? They're a ginormous behemoth in residential real estate. And there's somebody that I'm trying to cover more, write about more, and also bring them into my ResiClub audience just because they are so massive, right? And they're also a harder group to reach because they're not always necessarily focused on real estate, in terms of like communities. Some of them, this is kind of like their 401k. They're kind of doing it individually. They're kind of like disconnected, and they're kind of hard to find. They're all over the place, right? They could be anybody.
I think you probably saw Jen's comment. Shout out to Jen Rulin. I'll have the editors put up the post. That's really what she was lobbying for, is so much of the data. I hear this all the time, Lance, and I'm sure this is this is one of those things that's easy to say, hard to solve. But, this industry knows that the data that we see on investments and rentals are largely coming from the large players. And we know that that's a segment of the market. And so I can imagine how hard it is, as every real estate investor I know says, I don't know how they're reporting on whether rents are up or down, because I've never got a phone call from anybody about what my rents are, and so the only people, when people are running that data is, is the rental market softening? Is it strengthening? What are vacancies looking like? What are days on market? So much of that is just coming from the largest players, which is a smaller part of the market. So any comment on that? Or is that on your radar? Is that just impossible to pull off?
The rental market is hard to track, a lot of different aspects of it. I focus more on the purchasing market. That's kind of where more of like my expertise has been for a long time. And it is easier to quantify, right? Like, here's how many active homes are for sale. Most states, home sales are public record, although there are those, non-disclosure states that drive everybody crazy. And so there is some truth to that, right? Where the rental data, and another thing with the rental data is when you look at it from the various different sources, you often get different stories, right? It shows different things, right? Whereas the purchasing market, whether you go to Zillow, Realtor.com, whoever, usually it's telling a fairly consistent story. And so I think there is some problems with some of the rental data that's out there. And
absolutely.
That sounds like a problem for ResiClub to try to solve.
I wanted to put that on your plate as an opportunity that my market would be willing to help in any way, and probably be hungry for whatever that product is if you can pull it off.
I'll put it on the to-do list.
Great. Well, it's fantastic. I wanted to talk about that, and we're going to talk a little bit more about the products you have and how people can use them. But since I have you, I obviously follow you, and there's some headlines coming up, and I know you've got data. So I want to transition into kind of talking about what you're seeing right now, where your brain's at, what people are talking about. You mentioned before, you have a couple charts that you update quarterly or you go back to all the time. Having followed you for over a year now, the inventory across the U.S., right, and breaking it down by market is something you're constantly reporting on. And you do have this kind of benchmark pegged around pre-pandemic. What were things like in 17, 18, 19, which I don't want to put words in your mouth, but I think a lot of people consider a healthy market in the U.S. and so we're kind of always benchmarking against that. So my purview from just, reading the headlines is that inventory across the U.S. Is rising, but that it still seems down from 2019. Do you want to just kind of elaborate on what you're seeing at the most macro level across the U.S. on inventory levels?
That's right. And so what we're seeing in the U.S. is we've seen inventory on a nationally aggregated basis on an upward trajectory. And if you zoom out, a lot of that upward trajectory has been since the lows of 2022, really March 2022. And while it hasn't grown upward in a straight line, the market did start to tighten a little bit in 2023 in a lot of places. It has been on an upswing. And nationally, we're still down 20% from pre-pandemic levels. Of the 200 largest markets, you do have 58 now that are at or above 2019 active inventory levels. But then on the other side, you still have 42 of those 200 largest markets that are down more than 50% from pre-pandemic levels. And when you're down 50%, that means for every 2 homes that were for sale in 2019, there's just 1 now. So you still have pockets of the country that are fairly tight, while you have others that have loosened up a lot. But I think the big picture is, while you hear a lot of like headlines about housing and whatever's going on in the news cycle, the biggest thing is to zoom all the way back to 2020. And I think if you zoom back there and you tell the story as the way I'm going to tell it, things start to make sense. And so what happened in the U.S. housing market in 2020 during the pandemic period and coming out of that lockdowns is that the housing market went into a boom mode. Housing began to overheat because there was so much housing demand. The Federal Reserve estimates that to match the increase in housing demand that happened during the pandemic, and that this was happening because of work from home. This was happening because also people who weren't doing work from home, like the people fleeing New York, San Francisco, Los Angeles, to go to Austin, to Boise, to buy more housing than they would have in those cities, called work from home arbitrage, where they kept their higher incomes and bought in those markets. Even the people who stayed in the New Yorks, the San Franciscos, they still had increased demand for space. There was a lot of roommates who, were working from home, and they were used to seeing their roommate 3 hours a day. Now they're seeing them 12, 15, and they're like, I hate your guts. And so it created an increase in household formations as people wanted more space, people wanted more offices. And so there was an increase in 1 million more households were formed than otherwise would have been formed. So work from home, increase in demand for space, the ultra low mortgage rates that made everything cash flow almost, right? Mm-hmm. And then as prices ripped, as all the stimulus came in, as rents ripped, it just created also more demand as people chased it, right? So the Federal Reserve estimates that to match that increase in housing demand, home construction housing starts would have needed to increase 300%. So for every one home being built, we would need 4 being built. That's impossible, right? You can barely go up 10, 20% for housing starts, 30% in a small window, because there are labor constraints. Only so many people know how to do the various things in making a home at a given time. There are supply chain constraints, right? You have to have a supply chain for softwood lumber, for the things that make drywall, all of these different components that add up. So you cannot increase home construction that fast. So what happens? Well, home prices are, there's all of this demand out there that cannot transact into the housing market. And so it just piles on the market and it overheats the market. And so the people who do get to transact are those that pay the highest dollar amount. And so what occurred essentially is that we pulled a lot of demand that would have been like, let's say 2023 demand, 24, maybe even 25 demand, and we pulled it into that pandemic window, and it overheated the market. And so as that occurs, and then you follow it with the rate shock, the average 30-year fixed mortgage rate going from 3 to 4 to 5 to 6 to 7, so fast, that created the fastest ever deterioration in housing affordability. Now, housing affordability today, when taking into account prices, incomes, and rates, it's not worse than 1981 when you had 18% mortgage rates, but it's also not that far away when you add in property taxes and insurance. So the market is trying to stomach this this deteriorated affordability. And so because of all of that, we are still in this period where we are in a period of recalibration, right? Or normalization. And in some markets, normalization might, seem very, it might be a very soft thing, right? And then in other markets, like some of these pockets of Southwest Florida, some of these pockets of Texas, Austin, San Antonio, it might be actual correction, right? And prices coming down. And so I think big picture, that's how I see this market, is one where we went through this very big overheating and this huge pull ahead in housing demand, and to a market where we're trying to stomach that. And so that's why active inventory is rising. It's these affordability dynamics. Now, the longer that this goes on and the more time that incomes have to rise, and let's say we did actually get mortgage rates down a little bit, and let's also say maybe that price growth decelerates more, or some of these markets give up a little bit more in prices. If you get a little bit of help from any one of those levers or combination of the levers, you can get affordability to a slightly better place that starts to create a healthier market. starts to create a market that feels a little bit normalized, and also a market where you start to get a little bit more resale churn. And while prices nationally haven't really given up that much, if at all, on a nationally aggregated basis, you have seen the resale existing homes sales fall very sharply, right? That occurred in the second half of 2022, and we've really stayed at that place for almost 3 years now, where we haven't gotten much growth in existing home sales. And if you look at it at a whole number, we are at the lowest level of existing home sales since 1995. But we also have 70 million more people, almost 80 million more people in the U.S. than 1995. We have more than 30 million more households than 1995. So if you adjust it for population, we are at almost 40-year lows for existing home sale turnover. But over time, the longer that we are in this period and, incomes can kind of catch up, maybe we get a little bit off the rates, maybe prices in some of these markets fall, you can start to get affordability to a slightly better place, and that could also begin to bring back some turnover. And turnover will also increase as lifestyle events add up. So my view with the rate shock-induced lock-in is that it is the strongest right out of the gate. Because right out of the gate, 2022, when rates shot up from 3 to 4 to 5 to 6 to 7%, that's when people whose monthly payment was, let's say, $1,500, and if they were going to buy something else would have been $3,000. That's when they're like, I'm not doing this, right? This makes no sense. I'm waiting for rates to come down, right? But that same household, as lifestyle events might occur, let's say they live in a 2-bedroom house and now they have 2-3 kids, the wife's starting to get unhappy, that starts to increase those psychological switching costs where that family might be like, you know what, going from $1,500 to, let's say, $2,500 monthly payment. Yeah, that might suck, but they might need to do it to kind of keep the wife happy. Or also during that period, maybe their income also increased, right? And so they're no longer giving up the same percentage of their discretionary income as they would have before. And so all of those factors over time should begin to increase existing home sales a bit and increase a little bit of turnover. And I think for investors, the reason that matters is that, it could create some churn in some of the parts of, the market and create some listings that they would have liked to have seen that they aren't at the moment, right? Because even though active inventory has increased, and even though a number of markets have gotten at to or above 2019 levels, around a quarter of markets, even in those places, there's still not a lot of churn in terms of the new listings coming in. It's kind of like a lot of the stale stuff that's kind of stacked up. And so I think over time, as those switching costs begin to ease, you should begin to get a little bit more turnover in the market. And sorry if I went on a long-winded tangent. I just kind of want to zoom out because you hear so many headlines and people's attention's always pulled in different directions. I think it's really important to kind of like zoom out and see what that big picture has been for the past few years. Because housing moves really slow.
Yeah, I think the big picture is important here. Because people are chomping at the bit to jump on little trends, and you can't look at those little data movements without the context. So the good news is, Lance, is you probably answered 4 questions I had in that answer, and that was great. So first of all, I'd say the numbers you used there, I'm in South Florida. I was just like, we need to double or triple those numbers. You know what I mean? Going from like a 2-bedroom to a 3-bedroom is not $1,500 to $2,500 in this market. It's going to be double that. And so that just shows you, how different it is across the country and how unaffordable some markets can seemingly be to somebody. And, so I love this. There's this guy that I follow, Jason Hartman. I'm not sure if you're familiar with him, but he's very much in real estate. And I went to one of his events, and the most amazing thing I heard at that whole event was the worst person to value a market are locals, because they always remember what it used to cost. So it always takes an outside investor to kind of come into a new market to be like, hey, this is crazy. these 2 bedrooms are way underpriced, because the local is always going to remember what it would cost 5 years ago, 2 years ago. And I thought that was like such a sage thing, which is where I think that this data is very important for investors and for people advising investors. So if there's anything that I can say with certainty about the real estate market is, everything we knew about real estate, that everything that we should have said, because of this, prices should go up or down, because of this, rates should go up or down, has turned out not to be true in the last 4 or 5 years. So if there's any argument that history does not repeat itself in real estate, I think it's the last 4 or 5 years. And I look at it as anytime, we're in business, anytime you do a forecast and a spreadsheet, everything is built on the bedrock of assumptions, right? I assume this, I assume a conversion rate, I assume a default product rate. So what I'm taking away from this, Lance, and I want to, ask you a couple questions about this, is that it's just really important for us to get those assumptions right to make any bet. And so when you said you wanted to zoom out, you want to talk about the story, I think that's what we're talking about, because we've never had rates go from almost free, sub 3% to double or triple in a couple of months. We've never had the population grow. You were using, 70 million. I mean, when I think about the population from the 90s to today in percentage terms, that must be 40% growth. I don't know if I'm overselling that. It's a big amount, right? I remember always thinking
it's a chunk.
Yeah, it's a huge chunk, right? And so the population, the household formation is growing. I do think, counter to all the conversations about immigration, about illegal versus legal, people are still moving to the U.S. Countries are still sending their college kids here. They're staying. We still have, the H-1B visas. They're still coming in. The millennial, more 30 somethings than ever are coming of age to buy a house and start a family over, the last 2 years and the next 3 years. I think I've seen the data. And so I think that I come back to what are those assumptions in the spreadsheet? And it's just different than we've ever seen before. So I want to ask you a couple of questions about that. Obviously, what's the assumption about what changes based on the lock-in effect? There's people that are sitting on their 2% mortgages. Do they just decide to rent that if they have to move? Do they basically say, okay, at some point I just got to move on? What do you think that how does that change the market? And I got a couple more to ask you after that one.
Yeah, so there will be some accidental landlords from this, right? No question about it. The problem with that part though, and why it might not be as many accidental landlords as people think, is that part of the reason that they are locked in is because they can't stomach and might not even be able to afford, in terms of eligibility, to sell their house and buy something else at today's rates, right? Mm-hmm. And so to be able to pull off an accidental landlord, you need to be able to afford to keep that property, right? And to not need that equity to buy the next property. Yep. And so the affordability thing that's locking them in could also lock them in from becoming an accidental landlord, or it might just kind of push out their horizon when they do become an accidental landlord. So you could have some people who, are locked in today, right, and don't become accidental landlords until 28, 29. And these might be more of your number people, your people who are actually doing the math and are like, you know what, this 2% rate at a 30-year, this is an asset. I'm going to try to keep this, right? And it might make sense to keep this as a rental. So I do think you'll see some of that. It's kind of hard in the short term because, there's an affordability aspect to it. And so I think that part will affect the investor community from the lock-in effect. I think the other thing that will affect the investor community is already what's occurred, which is this very big pullback in existing home sales, right? That part. Mm-hmm. And then I think for investors, they are kind of feeling, maybe for some investors, the biggest impact isn't necessarily the lock-in effect. It's more of how they have been affected by the higher rates, which is a bit of a lockout from some properties, right? Where some properties in some markets no longer cash flow that did before. And so I think that's really more of what investors have felt, is just recalibrating themselves to this different environment and kind of coming to terms with the fact that, you know what, these 4% rates, 3% rates, those are a thing of the past. And then if they did come back, that wouldn't necessarily be a good thing, right? That's like a big question. And so I think, I think that's what you're seeing in the market, is kind of recalibrating to this environment.
Yeah, that's what I say, recalibration. That's where I think it's also that kind of furthers my point in a different way of the old playbook may not be copy and pasteable to right now, because we're still figuring some things out. And that's where I really like to focus on the fundamentals. So supply and demand, you mentioned it. I mean, that is the universal thing that's the hardest to argue with. So going to, the IMNs, and I went to a bunch of real estate things, and I've watched your data. I think you talked about this at your New York event. All of a sudden, all of that like pent up demand for new construction that got stalled during COVID started coming online. But I want to know what the data says, because this is anecdotal, Lance, but I have several friends that are developers and that are in tune with some of the larger developers. Doesn't seem like a whole lot of new stuff is starting. Like, what's your overall sense in the data in terms of new units coming online?
Yeah. So what we've seen in the data is we've seen a little bit more resiliency from single family, where, some of the rollover in housing starts, that was really starts that the builders couldn't even complete, right? Because they were so far behind during the pandemic. And so as that rolled over in 22, it didn't have, a huge decrease in 23, 24 completions, because that really builders weren't able to, they were starting homes faster than they completing them, right? So there was a bit of a backlog that needed smooth. Now on the multifamily side, this is where things get a little more interesting, where during the pandemic housing boom and the period of ultra low rates, there was a ton of projects financed, right, at those low rates. That takes a lot longer to feed into the pipeline, right? And so we've since seen a very big rollover in the number of multifamily projects being financed, right? And it's just taken a while to get to the part where this will roll over for completions. So multifamily completions in 23 and 24 were very high. Actually, the highest since 1978, because it was all of those projects that were financed during ultra low rates, right? Mm-hmm. But at the same time, while completions in 23 and 24 for multifamily were soaring, starts for multifamily was falling very sharply. And so in 25 and 26, later this year and into next year, we're going to see more of a rollover for multifamily completions, and the amount of new product for multifamily that's coming into the market is going to go down. And so I think that should in itself create a little bit of a firming in the rental market, whereas all those completions from the multifamily side really loosened it up, right? Created a lot more softness in the market. And I think now that you're going to see less of those multifamily completions, that should help to tighten up the rental market. Now, for single family, this is where things get a little more interesting. Is for single family construction, even though the affordability environment shifted very sharply, a lot of these home builders, in particular the Lennars and the D.R. Hortons, continued to push forward. And they made a decision to choose volume over margin. And so what they did is they did affordability adjustments, these bigger buy downs, maybe it's money back at close, whatever, to continue to move volume the past couple of years. And so their number of net new orders have actually stayed, at all-time highs pretty much. And they've compressed their margin a bit. Now what's interesting is the past 6 months, we've kind of shifted there a bit, where the market and the purchasing side has softened more as active inventory has risen. And so builders are having a harder time moving that inventory. And so they're doing even bigger affordability adjustments. And Lennar's margin for this Q1 quarter that they just reported was their lowest gross margin in over a decade. And so now it's getting to a question of, are more of the builders reaching that point where, they've come down off the all-time highs for profits during the pandemic, and now some of them are starting to normalize back to pre-pandemic levels, but some of them are starting to even slip below that. And could we reach a point where they're like, you know what, we're not going to cut margin anymore, and we're done with the volume, and then the volume starts to decrease. So that's what I'm watching out for. Now, on the smaller builders, you have seen more of them pull back. They get a little more skittish, especially in the shifted lending environment where some of them are having a little harder time accessing lending. But that also is creating some opportunity. Progress that I mentioned earlier, the private equity firm that owns them, not only are they raising more money to buy Section 8 housing, but they also are raising more money. I believe it was like $500 million plus to do more financing for smaller builders to kind of step in where some of those community banks have pulled back. So that's kind of interesting to see as well. But So in terms of my outlook there, I'm still kind of trying to figure out what's going to happen for the single family builders. You have seen margins pull back more. More of them might get to the level where they're no longer chasing volume as much. And you have seen the amount of completed, unsold, new single-family build inventory reach a 15-year high. Now, if you adjust it as a percentage of single-family starts, it's not quite as high as it might seem, but it is rising. And so as more slack gets into the market, more of the builders might become more conservative. So I'm still trying to figure out where single-family construction is going to head. But multifamily, that's rolling over. You are going to see fewer completions come into the market over the next 16, 18 months.
Yeah, I would love to see that data as you follow it, because like I said, it's totally anecdotal, but I know there was this big, like you explained exactly why all of a sudden more of the, especially single family. I mean, I know why multifamily came on, and, again, very anecdotal. I drove around any downtown or reasonable city, and I travel quite a bit. And there's skyscrapers going up, mid-rises, there's cranes everywhere. But you drive around and you look for like a single family development. Of course, it's supply of the land. You go way outside of the city, and so they're just not doing that. And so I think like centrally located single family, like 4 walls in a backyard is just like it's going to be a very sought after, inventory in my opinion.
Yeah. So let me pull up some of my data. So this is this is year-over-year change in active inventory for sale across metros in the U.S. And everything that's green is where inventory is rising. Everything that's brown is where inventory is falling year-over-year. So green inventory up year-over-year, brown inventory down year-over-year.
In size of the bubble is population or number, I should say?
Number of homes for sale. Condo and single family. So like Miami has the most total active inventory in the country. A lot of that has been what's happened in the condo market there.
I would say that's where I talk about the cranes being everywhere I drive around. I'm close enough to that. I'm seeing that actually happen.
Yeah. And so I do use the bubble as this kind of like to kind of understand how big that market is, right? And so it's rising year over year pretty much everywhere in the country except like an outlier here or there, like in the Dakotas. Now, if you look at it from comparing it to pre-pandemic levels, and of all the maps and charts I make, this is my absolute favorite one right now because it does a great job showing the supply-demand equilibrium across the country. And the markets that are green here, especially dark green, this is where buyers have gained, and investors who are buying as well, a lot more leverage in the market recently. The markets that are dark brown, this is where sellers have retained the most power across the country. And the reason that a lot of these Gulf markets in the Mountain West have seen inventory rise faster and back to or above pre-pandemic levels is that those markets got hit by a greater demand shock as the pandemic migration wave pulled back. And while those places are all still seeing rising population, people are still moving to Florida, people are still moving to Texas, people are still moving to Colorado. It's not like it was in 2021 and 22 and the end of 2020. And so as you have fewer people with bigger, deeper pockets moving into the market, those markets have had to rely a bit more on local incomes. And given the fact that those markets also ran up more for prices during the pandemic housing boom, it makes it a little more strained on the market as they rely on those local incomes. And so places like Austin got up 70% for prices during the pandemic housing boom. Then a lot of the people who were moving in from California stopped moving in. While you still saw some people moving in, there was fewer. And so you had to rely more on your local income base. And given that a lot of the local incomes couldn't necessarily support it, you saw active inventory begin to build. The other factor there is that in the Sun Belt, there's a lot more construction, multifamily, single family. And so builders, in order to move the product in this affordability shifted environment, some of them will do bigger rent concessions. And on the single family new build side, they'll do these bigger buy downs, they'll do the bigger incentives. So they're doing things that can kind of help to ease the affordability environment. And so that pulls some of the buyers who would have otherwise bought in the existing resale market, and it pulls them to new construction. I've talked to investors as well who only bought resale and existing before, but now given the affordability adjustments and some of these deals that they've gotten from the Lennars of the world, they've actually bought some new build properties. And so as that occurs and it pulls some more attention from resale existing to new build, it puts upward pressure on the inventory in the resale existing side. Now, why has the Northeast and Midwest stayed so tight? Well, those are places that don't have a lot of construction, right? And so given that they don't have as much construction and they didn't have this construction in the pipeline heading into the shifted and affordability environment, they don't have the affordability adjustments that are pulling their buyers from resale existing to new build. And so that has kind of helped to firm up those markets, keep them a little tighter. And some of these places have benefited from the fact that the pandemic housing boom migration wave decelerated. And so while there are still Americans moving out of Boston and New York and heading to Florida and Texas, it's not as much as it was 2-3 years ago. And so that helps to also stabilize the demand environment in those markets. And so here's prices year over year. Nationally, we're still up 2% year over year. Most markets are up, but you will see the strong correlation between this pre-pandemic levels for inventory and 1 year price change, where a lot of these markets in the Mountain West and the Gulf are flat or maybe down 1% too, or the same places where inventory is at or above pre-pandemic levels. And then the markets where prices are up, 5, 6, 7% year over year still are the places where inventory is down 60, 70, 80% still from pre-pandemic levels.
That's a great share. I'd love to bring you on a couple times a year if you'd be up for it and just review those graphics. I see why they're some of your favorite. It shares a lot. And data is what you're good at. Lance, if I can put you on the spot, I want to ask a couple questions about prognostication, about what you think will happen. So when we talk about new construction, you can stop sharing if you want, so we can see each other. When you talk about new construction, I would like to hear your thoughts on this, because a lot of people talk about replacement cost, right? You know that term. It's like, what is the home for sale versus what it would take to replace that? And as we saw, like after the pandemic, replacement costs went through the roof, right? Just the plywood is the thing that everybody talks about, or the lumber. So I'm going to use the T word. We're talking about tariffs right now. We don't know if they'll actually be enforced the way we think they are. But have you thought at all about what tariffs could do to the housing market over the next year?
Yeah. So when it comes to the tariff shock and everything that's going on there, there's a few things I want to point out, which is that in the U.S. housing market, for multifamily and single family, 7.8%, let's just say 8%, let's even just call it 10%, but it's 7 something percent of the materials that go into single family and multifamily construction are imported, come from other countries. And, that number gets to be higher for drywall, the materials that go into making drywall, and then also softwood lumber, where around 30% of all softwood lumber comes from Canada. Now, right now, as the policies from the White House are stated, as of this chat, currently, Mexico and Canada, as long as they apply are in compliant with the existing trade agreement, there isn't the additional tariff. Now, and so lumber doesn't have an additional tariff from the White House. But there is a long-standing review process that is automatic for lumber coming from Canada that goes through the review process. Last year, it jumped up to 15% duty on lumber. This year, it's about to jump up to 34%. So even if the White House does nothing to Canada, the tariff on lumber will increase, the duty will increase to 34%. So that is something to kind of keep a little bit of an eye out on. But at the same time, lumber, if you go look at the trading market, is only up like 2% every year, and a lot of that is already priced in. Mm-hmm. I think the biggest concern is probably in appliances. A lot higher percentage of appliances are imported, and a lot of them come from China. So that's where you get a little bit more risk. John Burns estimates that if all of the tariffs that the Trump administration is discussing were to go into effect, it could increase the construction on the typical new build single family by around 8,000 or 5%. But I think really the biggest thing here is, and by the way, that estimate, a lot of those tariffs that are in that calculation were actually pulled back this week. They were paused for 90 days. Now, I think the biggest concern here is for housing and construction and just everything is not necessarily the increase in inputs, the cost. It's actually just what happens to the overall economy. Because while we know of housing and construction as being this very important thing for the economy, we're around 5%. Residential construction is 5%, 1/20th of the U.S. economy, and that is a very important percent. Usually if it contracts significantly, we're in a recession, right? Mm-hmm. Imports are now 14% of the economy. So imports are almost 3 times bigger piece of the economy than construction for single family and multifamily. And that percentage from 1960s to today went up from 5-6% to now 14% as we went through this rapid period of globalization in the 70s, 80s, 90s, and the aughts. And it really topped out in 2008. And since we've come down just a little bit from the peak. So what I'm really getting to there is imports are a really big piece of the U.S. economy, and how the tariffs impact the overall economy might be the bigger concern and potential headwind than the actual inputs themselves, which only make up 7-8% for new construction. And so I don't really know how all that's going to play out. That really kind of goes above what I kind of get into and analyze. But I do think that that's where I'm the most concerned is just, imports are really a big piece of the economy.
Yeah.
Does that play out on the macro side? And then the other factor here is we don't even know what tariffs will actually go into effect, how that will play out long term. What are these negotiations going to look like? I think right now the word that I would use is uncertainty. And as a market participant, you are always going to have uncertainty. Sometimes it's higher, sometimes it's lower. I think it's fair to say with all this tariff stuff, the uncertainty is much higher at the moment. And so I think that's where we are, is additional uncertainty in the market.
Agreed. I like how you actually hit the other side, the supply. It's not just the costs that would go up, but maybe the demand may go down if the economy takes a hit. people may not be bidding as much money on these homes, and that's something to consider, which is a totally different side. All right. So bold prediction, for generations, long before you and I were here, Lance, in the U.S., if you look back, you basically could not lose money in U.S. housing if you held a home for 10 years or more. And often that was probably like 5 years during most of our lifetimes. Do you think that's a fundamental that will stay true over the next 10 years?
I think in this market, given where affordability has gotten, there's obviously some downside risk, right? There has been the past couple years. A lot of that hasn't manifested like the industry kind of thought it might, right? It has been a little more resilient than people expected. But I think with that elevated just potential of downside risk, I think it makes some of these shorter term investments a little riskier, right? And that's been the case the past few years. But I think if you have a longer horizon, right, long-term horizon, that's where that downside risk really gets decreased, right? The longer the horizon you have, just given the history of the asset class, it reduces potential risk. I do believe that if you go back through history, and I've done it myself too, and you even look at the regional side, the longer you hold, especially 5-10 years, you really made it hard on yourself to lose money in a lot of these markets over history.
Yeah. What is the cliche? Time heals all deals. I think that's still going to be the case. So obviously we want your data so we're making better short-term decisions. But I think at the end of the day, sometimes like you said, it's a market of uncertainty. There's risk. One of the easiest things to remind yourself of is if you zoom out long enough and you're not, gambling with money, or you don't have investors that you owe returns to, still an amazing asset class. But let's talk about ResiClub. Lance, I really appreciate your time. Like I said, I've become a huge fan. Just kind of walk us through the product you have to offer and who should be interested in it.
Yeah. So if you go to ResiClubAnalytics.com or just Google ResiClub and go to my site, you can put in your email and get signed up for my free list. In my free list, they get a few articles a week, they get a good number of my charts, they get some of my maps, and kind of a little bit of my reporting. And then I have a premium product that's an annual subscription called ResiClub Pro. They get 3 additional housing reports per week. A lot of those reports, I try to have a lot of data for 3,000 counties, 800 metros, whether it's active inventory, whether it's non-renewal rates for insurance premiums, forecasts for insurance premiums, forecasts for prices, rents, a lot of those different metrics, and just access to more executives across the space and kind of what they're thinking. My premium members also get access to my webinars. I do a monthly one where I get on and talk about where the housing market is. I also have a series of webinars I'm going to do for my pro members that are teaching things. So teaching how people can make charts and maps if they want to, create their own content. I have another one that's going to be on how to build your own local housing market newsletter. So if you want to take my content and be able to create, a market newsletter that could create even leads for you, whether you're a home builder, you're a single family investor, a real estate agent that you're trying to get eyeballs in your local market to kind of create potential deals. I think there's a way to use my content, my pro members, to kind of really simply build a really high level local housing market newsletter, given that I have so much local reporting. People could screenshot it, grab their local market that's interactive. And then my pro members can also use any of my charts, maps in their own content and get access to my spreadsheets, my housing trackers for inventory and prices.
Yeah, I just want to elaborate on that. I think that, you probably built that more for transactional brokerage real estate agents, but I think anyone watching this that is basically educating and advising local real estate investors in your market as a property manager, or even as somebody who's helping them find new investments, I think that market-driven newsletter would be an amazing lead gen tool and basically solidify you as a trusted advisor in your market. So I'm going to check that out, Lance, and I'm going to invite some of our clients that I think that's going to be a really good thing. Really appreciate all the data you share. Like I said, I've been a huge fan. It's been amazing to watch you grow. I know you're going to be at the Strategic PM Summit. Obviously, you're going to come with tons of data. What can the audience expect to find or learn from you when they come to hear you in Lauderdale?
I think connecting the dots in the market today and where the market's going to be at the end of the year, and looking ahead to 2026, which is kind of a weird thing to say. I'm still kind of getting used to saying 2025. And then the other thing is just how to better read housing data in general in a very simple way. And so I think if I can kind of help people to identify some up and coming trends, can help them to better understand the market today, where it might be headed into 26, and then how to better read housing data, I think I would have done a good job.
Lance Lambert, follow him on LinkedIn, follow him on X, check out ResiClub Analytics, sign up for the newsletter. I do, like I said, it's my inbox space is sacred, but I let you in every couple of days, and it's always amazing. I appreciate you, Lance.
Thanks, Jeremy.
Hope you enjoyed that conversation as much as I did. And now let's transition to when you may actually see us in person. So I want to go through the event calendar. The next event we know about is March 12th through 14th, and that is the NARPM Northwest Regional Conference, which this year is in Portland, Oregon. After that, Redvine is having their inaugural user conference. It's May 21st to 23rd, and it's in Tampa, Florida. Then you'll definitely see Jen and I, because we're speaking at the NARPM Southern States Conference in Birmingham, Alabama. And this year, those dates are June 11th to 13th. Now, after that, we've got the event that Lance is speaking at, as well as many others like Mike Michalowicz and John DeJulius, and a number of your favorite property managers. This is really going to be an amazing event. It's called the Strategic PM Summit. It's in Fort Lauderdale, Florida. It's at the Tower Club. It's on it's on the top floor of one of the tallest buildings in Fort Lauderdale. Amazing views, a great place to work on your strategy. It's August 21st and 22nd. So to learn more about that event, or to make sure that you follow us anywhere that you want to consume more info on being a strategic PM, follow us on Facebook, on YouTube, on X, and on LinkedIn. And you can always find more information and interviews like this on strategicpm.com. Now, I appreciate you following us and being here, and I hope to see you at an event soon. And that, my friends, is what's happening this week in PM.